Hey traders, it's Chris Vermeulen from TheTechnicalTraders.com. I want to share with you a little tiny trading tip that you might find extremely valuable in your day trading and swing trading moving forward. Now, this tip is really something fairly simple, but it gives you some good insight as to where the big money has things kind of mapped out to go into the future. Now, let me show you what I'm talking about. So what we're looking at here is the SP500. Wherever the SP500 goes, the rest of the market pretty much goes. It is considered the SP500 or the Dow. They pretty much move in sync to be the tide. So when the tide goes up, pretty much all boats go up. When the tide goes down, most boats go down. So with that said, focus on the SP500. The SPY is a great ETF for this. It shows us where the big money has got positions more or less kind of stashed away as a fail-safe. And when there's a lack of liquidity or technology slips and for some reason orders kind of slip past bids and asks, we can see where the next major support level is, where there's huge money sitting there waiting. So let's just take a look here. What we're looking at are these intraday, these candle spikes. And you'll notice a whole bunch of them across the board. And what is significant about them? Well, they're kind of like it's foreshadowing where price is likely to go. So for example, we see this huge spike up in price, and within within really, this is a 30-minute chart. So within that trading session, we saw price come up to that level. And we should know that when price gets to that level, that's where there's going to be some big money sitting there with a big order. Obviously, if there wasn't money sitting there, the spike would be even higher until it ran into some serious resistance. So that is where, when all kind of when the market moves, that's where it's going to find its next kind of resistance zone. Coming down here, we had another big spike right up to here. And if you notice the next session, it came right up to that level and sold off. Over here, we end up having a big spike here in price. And of course, price ended up popping more or less up to that price. It's not exact science. It just gives you a ballpark figure where price is likely to go. Over here, we had a big spike down on the SPY. And then over the next trading session, price came right down to that level. And then we had a huge spike to the upside. And of course, the following session, big move back up to that spike. Over here, the market moved down. We had a huge spike to the upside. And of course, within the next trading session, price came back up to that spike high. You can see here, spike low, foreshadowing price could potentially go back down there. And of course, it did. Over here, we had a spike low on a bar. Of course, price rallied up. Eventually, it came back down the next day, gapping down to those prices. And then really just the big candles are the ones we're really focusing at. You can see here another one here on January 22nd. And we've got a big gap up to that level. And, you know, right now the overall trend is down. It looks as though the market is trying to turn around, but we've had a gap to the upside. The bias is still leaning to the downside. So I wouldn't be surprised if we see price fade back down, kind of fill this price gap. Usually gaps get filled. And this downward candle kind of confirms that that is likely to happen. It doesn't always happen, but you can see here, it definitely provides these candle spikes some pretty good insight as to where the big money players already have the market mapped out for the day or the next 24 hours where price is likely to reach. Anyways, hopefully you find that little tip interesting. It does work. It does help trim positions to lock in profits when those levels are reached, or to tighten stops, or to potentially enter new positions. So take care and talk to you soon. Bye-bye.